Hello, everyone. Good evening. Thank you for joining us tonight. My name is Anita Caswell, Wealth Manager at BMP Wealth. And joining me today, you can't see him right now, is Mr. Jason Pearce, Head of Technical Sales, Hong Kong and Northeast Asia for Quotas International. So why BMP Wealth? We are an independent financial advisory firm here in Hong Kong. And our focus is to help clients achieve enough money for the rest of their life in the lifestyle of their choice. So that number enough is different to every single individual and family. And this is something we do every single day. My team and myself have been doing this for 20, 30 years, and we are very happy to see our clients achieving their goals. But today, we're going to focus on people moving to the UK or have plans moving to the UK at some point in the future. So in the coming hour between myself and Jason, we're going to make sure that it's going to be informative and enjoyable. In the first 30 minutes, I will have Jason to go through the technical issues with you, i.e. UK taxes. But please do stay towards the end. I am going to walk you through 7 different scenarios, examples on some of the strategies that might be able to help our clients or yourself. However, I must stress everyone's situation is different, your situation is different, so that example would be a great idea to you to look at. Right, we welcome questions and please do ask questions. There's a Q&A box and towards the end of presentation, I will have Jason to answer your questions. 如果大家有問題嘅話咧，歡迎你哋咧喺個chat box Q&A 嗰度咧，用中文、英文答都可以。我哋喺個 presentation 最尾嘅時候咧，就會解答你哋啦。Right, I'm not going to keep you waiting. So Jason, may I pass it on to you?
Thank you.
Thank you.
Good evening, everyone. Thank you for joining us. So I'm going to give you an introduction to the UK tax system, which is very different to the system that we have here in Hong Kong. So I'll cover the first few points and then Anita will come back and talk about some of the solutions to what I'm going to talk about. So before we start, if you see something on a slide that's in green and in bold and underlined, it's a special legal or technical term. It'll be an English word, but it might have a different meaning to its normal usage in English. I'll show you an example on the next slide. But whenever you see something green, bold, underlined, it has a technical meaning. But for exchange rate purposes, I'm simply going to use £1 sterling for 10 Hong Kong dollars. And there's some acronyms. So HMRC is Her Majesty's Revenue and Customs. That's the UK equivalent of the IRD. Their job is to collect taxes for the government to spend on behalf of Her Majesty. CGT, capital gains tax, not a tax we have here in Hong Kong, happily, but we very much do in the UK. And another tax that we don't have here, but we again very much do in the UK, inheritance tax, which we shorten to IHT. Okay, so the first thing to understand then is something that is UK residence. What does it mean to be UK residents? And by this, I mean tax resident in the UK and therefore liable for UK taxes. So just by way of comparison, in Hong Kong, it's very simple. It's a simple day count test. So any individual who stays in Hong Kong for 180 days of 1 year or for 300 days in 2 consecutive years is tax resident in Hong Kong. Very simple day count test, nice and easy. The UK, somewhat different. We like to make things complicated in the UK. I don't know why, but we do. So the first thing to say is that the UK tax year is slightly different for historical reasons. Begins on the 6th of April and ends the following 5th of April. And every tax year in the UK is treated separately and independently and discreetly. So now, residence depends upon the number of days that you spend in the UK each year. So it's similar to Hong Kong in that way, but you'll see there days is one of these terms that's in green, bold and underlined, because for the purposes of UK tax resident, a day means being physically present in the UK at midnight. So if you take a flight to the UK and it lands at 1 minute to 12, that is a day of residence in the UK, despite the fact you're only there for 1 minute. If your flight lands at 1 minute past midnight, that in particular, the previous day isn't a day, but the following day will be. So again, 2 minutes can make a big difference to your tax outcome if you're on the threshold. Now, anyone that spends 15 or fewer days in the UK, they are categorically non-resident And again, when I say 15 days, I mean 15 midnights. So anyone can spend up to 15 days in the UK without worrying about being UK tax resident and subject to UK taxes. At the other end of the scale, if you spend 183 or more days of the tax year in the UK, you are tax resident. Okay, cut and dried. Though so far it's nice and simple. But what happens if you're in the UK for more than 15 or fewer than 183 days? Are you resident or not? Well, that will depend upon something we call the statutory residence test. It's again another technical term. This was introduced in the UK in 2013. Now, every accountancy firm and every insurance company, such as my own, produces one of these things. It's a statutory residence test flowchart. It's one side of A4, takes you about 3 or 4 minutes to complete it. And what it will tell you is for you individually, with your personal circumstances, for the current tax year that we're in, it will tell you what your day count is, whether you're UK tax resident or not. Now, I've just taken this from the bottom of it. We're looking at the right-hand side. The right-hand side applies to people that are arriving in the UK. The left-hand side to people leaving the UK to go somewhere else. So if you're arriving in the UK, you can actually spend up to 45 days in the UK rather than 15 and always be non-resident. So if you're going there, you don't have to worry about 15. 45 is at one end of the scale. 183, everyone's always resident, whether you're arriving or leaving, that's it. But if you're between 45 days and 182 days, there are 3 other day count thresholds. So your particular day count threshold for the particular tax year will either be 45, 90, 100, 120 or 182, and it depends upon the number of ties you have with the UK. That's things like, do you have property there? Do you got a job there? Have you got family there? And a few other things as well. But if you want to find out whether you're going to be UK tax resident or whether you were last tax year, you need to go through this flowchart. So, but you could spend 46 days in there. If you're at the lower end, because you've got a lot of ties to the UK, you can actually be in the UK for only a month and a half, but be tax resident for the whole year. So that means that you can actually be tax resident in the UK right now, despite the fact you're still here in Hong Kong. It's entirely possible and happens all the time. People's tax residency begins before they leave Hong Kong. So this is a very important point, because if you're actually tax resident now, things that you do now could have an impact after you've arrived in the UK from a tax perspective. And we've got a couple of examples later to illustrate this. But the important thing to note is, if you can, if it's possible, you should do all your financial arrangements and your financial planning in the tax year before the one in which you intend to move to the UK. So if you intend on moving to the UK, any point between now and April the 5th of next year, you'll still be able to do some financial planning, but there'll be some things that won't be available to you. If you're planning to go from April the 6th next year onwards, then you can do all your financial planning before next April the 5th, and you'll be able to do a great deal more than somebody that's going before then. Okay, so that's residence in the UK, but we have another concept in the UK called domicile. And this is something completely different to residence. There is some things in common, but it is legally a different thing. So UK residency, again, a technical term, it's straightforward. It's a day count. There are 5 thresholds, but it's still done by day count. Okay. UK domicile, which we call DOM, it's entirely different. It's a different legal construct. Hong Kong doesn't have domicile. Most countries don't. They just have residence, but the UK has done for the last 200 years. Okay. It's also different to permanent residency. It's different to your citizenship, your nationality, what passport you hold. It's a completely different thing. And I'll show you an example in a second of a real person that will illustrate this. There is no single legal definition in UK law of what domicile is. There's just case law. But very broadly, it's the country which you regard as your permanent home, or the country which you have the most substantial connections with. Okay, now for UK purposes, when you're born, if your parents were married and your father is still alive, you will get the domicile of your father. So, you know, if you're a Hong Kong person, your father was from Hong Kong, your domicile of origin when you're born will be Hong Kong, but it can change. If your parents were not married or your father had passed away before you were born, you will inherit your mother's domicile. So here's an example of a real life person, a friend and former colleague of mine. His name's Dmitry. He was born in London. His father was Russian and his mother was English. Now, they weren't married. They were just in a long-term relationship. They never got married. So that's where he was born, and that's his parentage. Dmitry grew up in the UK. Like many of us, he moved to Hong Kong. He stayed here for 9 years. He got permanent residency, but he's since left Hong Kong and is now living in Australia. Okay, so he has Russian nationality because he gets that from his father. His father was Russian. So that's his first country tie. But because his parents weren't married, he doesn't get his Russian father's domicile. He gets his English mother's domicile. So he's a UK domicile. So his nationality and his domicile are different. He's got PR in Hong Kong because he did it 7 years. He applied for it. He comes back for the necessary days to retain it, but he's not living here, but he has PR here, so he can come back. He's actually resident in Australia. So he has connections with 4 different countries all at the same time. Okay, so that just illustrates, and this is a real person, that his nationality, his domicile, and his residency are 3 different countries with tax implications for all of them. So for UK tax purposes, everybody in the world has a domicile. But if you've got no connection with the UK, never will have, that's clearly irrelevant. But if you're watching this webinar, I'm assuming that you either will have a connection with the UK or you perhaps have one already if you own some property there, for instance. So it is relevant if you are dialing into this. So if you were born there, if one of your parents was born there, to say if you've got any kind of real estate in the UK, it is relevant. Now, there is such a thing as dual residency. There's no such thing as dual domicile. You can only have one domicile at a time, but it can be changed. So if you're a Hong Kong person born here and lived here your life, for UK tax purposes, you're currently a Hong Kong domicile. But if you go to the UK, it can change to the UK, and there are very significant tax consequences if that happens. Okay. But if you go to the UK, initially, you will retain your Hong Kong domicile. You'll be a non-UK domicile, or what we call a non-dom. And there are some potential tax advantages, which I'll cover off. Okay, so let's look then at UK taxes. The first thing to say is that there are very different ways of taxing individuals in the world. In Hong Kong, it's relatively simple. Okay, the whole tax code is only 276 pages long. In Australia, it's a lot longer. It's 6,000 pages. It's much more complicated there and higher. The UK tax code, the last time anyone counted the number of pages was back in 2015, and it was over 17,000 pages. Obviously, every year in the UK, they have a budget, they'll have financial statements. So it's probably today at least 20,000 pages long. Okay. And back then again, at 10 million words. If you're familiar with the Bible, it's about 12 times as long as the Bible. That's what it looks like when it's printed out. Okay, so different countries tax their residents in different ways. The first and probably the most advantageous is where there's no income tax. So all the countries in green on this map. So probably the most well-known one is Dubai, where there simply is no income tax there. So whatever you earn there, you won't have to pay any individual income tax. The second one is in light blue, and that's what we call territorial tax. So this is where the country you live in will tax the income that you have in that country, but it won't tax any income that's outside the country. So that's what we obviously have here in Hong Kong, in Asia, also in Singapore and Malaysia. So if you're living in Hong Kong and you have income in Jersey or Switzerland or the UK or anywhere else, Hong Kong doesn't care. They only want to tax your Hong Kong income. But you'll see that by far the majority of the world is in dark blue. And that's what we have, what we call residence-based taxation. And that's if you're resident in a country, they tax your worldwide income. So everything that you earn or everywhere in the world is subject to tax in the country where you're living. So that's what we have in the UK and in Australia. For example, you'll see the majority of the world taxes this way. Hong Kong is very unusual. And then the final one is where it doesn't matter where you live. If you're a citizen of that country, you are subject to tax in that country, whether you live there or not. The most obvious example being the USA. So if you're a US person living here in Hong Kong, you still have to pay your taxes back in the US. Okay. Now, I'm going to explain why the tax rates in the UK and Australia are so much higher than they are in Hong Kong. Just to illustrate it, I'm going to show you how much money the governments of those 3 countries spend. because obviously if governments spend money, they need to get that money from somewhere, and it's usually by taxation. So these are the figures that I've got from the Statistics Department here in Hong Kong. I'll show you all the figures together in just a second, and I'll convert the currencies so you can see the differences there. This is from the Australian government website. Again, they declare how much tax they raise or how much they spend. And here's the UK, public spending as well. Now, what I'm going to do is show you the total government expenditure for the same year. But you have to divide that by the number of people, because obviously UK's got a much larger population than Hong Kong. So of course the government spends more money. So what I'm going to then do is show you how much money per head of population or per capita each government spends, which is the true comparison. And I'm going to put it all in the same currency so you can see an easy comparison there. So those are the figures from the three websites that I've just shown you, publicly available figures. Here are the populations of the three countries. So divide one by the other, and then this is how much each government spends in its own currency per head of population now. But obviously I've got three different currencies. Let's convert them all into Hong Kong dollars and see the result there. So Hong Kong, 81,000 Hong Kong a year per citizen or per resident here. The UK, 1.5 times as much almost. So the reason that taxes are higher in the UK, the government spends far more money in the UK than the Hong Kong government does. That's largely because in the UK, we have free schools, free hospitals, we've got armed forces to pay for, we've got an enormous welfare state. People get old age pensions when they retire, they get sickness benefit if they're at work, they get unemployment benefit if they're out of work. The government in the UK spends an enormous amount on the welfare state. That money has to come from somewhere. It comes from UK taxpayers. Okay, so when a UK tax is payable then, so I'm dividing it into different categories here because you've got income and capital gains tax, taxes on UK investment property, and inheritance tax. And it depends upon your residency and your domicile. So this is why domicile is so important, because it will affect how much tax you have to pay if you're UK resident. So the first category then is non-UK resident, non-UK domicile. So this is a Hong Kong person here in Hong Kong before they've moved to the UK. What exposure do they have to UK taxes, even though they're actually living here? Well, if you've got any UK sourced income, that is still subject to UK tax, even though you're living here, because it's UK income. So that's things like if you've got a UK bank account that pays interest, if you've got shares in UK companies and there are dividends and so on. So that's going to be taxed, even though you're living here. But any non-UK income isn't, because it's not in the UK and you're not UK tax resident. Let's say that you own a buy-to-let property in the UK. So you bought an apartment, you're renting it out to some students or something like that. The rental income is subject to income tax because it's UK income, even though you're living here. If you sell the property for more than that you paid for it, you will have to pay capital gains tax on that. Now, up until 2015, if you weren't UK resident, if you're living here, you didn't have to, but they changed the law in 2015, and now you do have to pay it. Inheritance tax. Up until 2017, if you were a non-UK domicile, so you're a Hong Kong person living here, and you owned any UK property through a company, you were not subject to inheritance tax. But again, another change in the law in 2017. Now, it doesn't matter whether you own it through an offshore company or any sort of offshore entity. If you pass away, that is subject to UK inheritance tax. So a massive change to UK inheritance tax 5 years ago. In terms of inheritance tax on other assets, if you own any other UK assets and you pass away, those are subject to UK tax. So the contents of that property. If you've got a car in the UK, if you've got a boat and you dock it in the UK, if you own a plane and you land it in the UK and you pass away, that will be subject to inheritance tax. But if you're non-UK domicile, any asset that's not in the UK is not subject to inheritance tax. So your Hong Kong property, your Hong Kong bank account, no, because you're a non-UK domicile. So what happens then if a Hong Kong person moves to the UK but retains their Hong Kong domicile? And I'll show you some example of this in just a second there. So you're a Hong Kong person living in the UK, so you're UK resident under the statutory residence test, but you're still non-domicile. UK income, yes, it's in the UK, so you still have to pay that. But for your non-UK income and gains, those are not subject to UK tax if you use something called the remittance basis. I'll explain more about this in a second, but it's been in the news very recently. The Chancellor of the UK, his name is Rishi Sunak. He's the finance minister. So his wife is Indian. She was born in India, parents are Indian, and she's still a non-domicile. She's been living in the UK for 9 years, but she's been using the remittance basis up until recently, where it's caused a lot of controversy, and she's now decided that she's not going to use it anymore because of political pressure. But I'll cover this more in just a second. As I say, UK investment property, always taxed. It doesn't matter where you're resident, where you're domicile, it's property in the UK, it's taxable. Inheritance tax, again, any assets in the UK you own, but anything outside the UK, no, while you're still non-domicile. Now, if you move to the UK and you stay there long enough, your domicile will change from Hong Kong to the UK. So you'll be UK resident and UK domicile, in which case you're taxed on everything. So this is why your domicile is so important, because you can see that you'll end up paying a lot more tax if your domicile changes. So the remittance basis then, how does this work? So this is for UK resident non-doms. Okay, you have the choice of 2 different ways of paying your taxes in the UK. The first is what we call the arising basis. Again, these are technical terms. So you pay income tax and capital gains tax on your worldwide income and gains as they arise. So I have a UK domicile of origin. If I ever move back to the UK, I will pay tax on that basis. I have no choice. But if you are UK resident but still non-domicile, you can choose to pay a different basis, the remittance basis. Now, any UK income and gains always taxed, irrespective of your domicile. But and also, if you've got income outside the UK that you bring into the UK, so if you're renting out an apartment in Hong Kong and you send the rent income to the UK, that's entered the UK tax system, that is going to be taxed. Also, if you sell a Hong Kong apartment and make a capital gain on it, and you send that money to the UK, that will also be taxed in the UK. But if you've got rental income or you sold a property and you don't send it to the UK, you don't have to pay UK tax on it. It's only if you remit it to the UK, which is a technical term. And again, I'll explain more of that in just a second. So you can choose which basis is the best for you. So for most people, it'll be the remittance basis rather than the arising basis for up to a period of 15 years. Now, you haven't got to decide during the year. So the tax year ends on April the 5th. You've got a few months then to the following 31st of January to do your sums and work out which basis is best for you. So you've got plenty of time to decide. Now, for the first 7 years that you're UK resident, there is no charge. You can just use the remittance basis and lower the amount of tax that you pay. But once you've been there longer than 7 years, they start to charge you if you want to continue to use this. Okay, so from years 8 to 12, you have to pay a charge of 30,000 sterling a year, roughly 300,000 Hong Kong, to continue using the remittance basis. If you're still there after 12 years, then from years 13 to 15, it goes up to £60,000 a year. So if you've been there 13 years and you don't have a lot of non-UK income and gains, you might decide to choose the arising basis instead and save yourself £60,000 a year. If you're still there after 15 years, from year 16 onwards, you'll be called what's called deemed UK domicile. You'll be taxed the same as any native-born British person. You won't be able to use the remittance basis any longer. So, but for the first 15 years, there's potentially a great tax saving. So, how can your domicile change? Well, there are 3 different ways if you move to the UK. I'm going to just talk about 2 of them tonight. But if it does change, or when it changes, it brings up your worldwide estate into the UK tax net for income tax, capital gains tax, and inheritance tax. So quite a big change if you've got a lot of wealth here in Hong Kong. The first is what I just mentioned, deemed domicile. That's very, very simple. That's simply spending 15 out of 20 years as a UK resident. It used to be 17 out of 20 years, and they reduced it in the year 2017. In the UK, the main opposition party is the Labour Party, and they have said that if they're elected at the next election, they will reduce the 15 out of 20 years to 5 out of 20. So again, a significant change if they get elected. The second is acquiring what's called a domicile of choice. Now, again, there is no legal definition of this, but it's broadly, you have the intention to settle either permanently or indefinitely in the UK. Now, for obvious reasons, people don't want to acquire a domicile of choice in the UK because they'll end up paying a load more tax. But if HMRC look at you and they look at your scenario, you've settled in the UK, you've got property there, your kids are at school there, you've got a job there or a business there, they'll say, it looks very much to us like you've settled here indefinitely, you've got a domicile of choice in the UK. Now, if there's a dispute between HMRC, the tax collector, and you, the taxpayer, this can only be settled by a court. And the courts in the UK, every working day, hear cases where there's a dispute between the tax collector and the taxpayer about their domicile. The third is called domicile of election. We don't have time to cover that today, but it's not relevant to today's things. Now, the good news is with this, as long as you do your financial planning before you're 15 out of 20 years, or before you have the intention to settle there, you can mitigate a huge number of the tax bills that you'll otherwise face. Okay, so how does tax in the UK work? Well, firstly, all earnings and pensions are taxed in the UK. And unlike Hong Kong, where pensions generally aren't taxed and annuity income is not taxed here, it is definitely taxed in the UK. Rental income is taxed, same as you pay property tax here. Now, if you're in Hong Kong, this is the only type of tax you have to worry about. If you move to the UK, there's a few extra layers on top. Okay, so savings income is also taxed in the UK. So any interest you get in your bank accounts and so on. Dividends are taxed in the UK. It doesn't matter whether it's from a private company that you own or from Tesla shares or something like that. Dividends are also taxed in the UK. Insurance policies are also taxed in the UK. It's a very benign regime, which Anita is going to cover. But again, insurance policies aren't taxed here in Hong Kong. They are in the UK. And then on top of all of that, you've got capital gains, which is a different type of tax, but it's linked to income tax as well. So you've got 4 different layers of tax to be concerned about if you move to the UK. Now, how much is the tax? Well, I'm going to simplify this, but I'm going to show you some real figures in just a second here. So on all of if you add together your UK income and any income that you remit to the UK, so you transfer it from Hong Kong to the UK, those are the rates of income tax that you'll pay. There are 3 different bands. It starts at 20 and goes up to 45. So the highest rate of tax in Hong Kong is generally considered to be 15%. That's lower than that's high. Sorry, the lowest rate of UK income tax is higher than the highest rate here in Hong Kong. Capital gains tax, if it's on real estate, it's got its own rates. That's on real estate. Any other assets like company shares, Tesla shares, anything like that, the rates are slightly lower, but they may go up in the future. I'm just going to scoot through this one here. Now, these are the actual numbers here. So if your UK income plus your remitted income is in any one of these 5 numbers here, this is the actual tax that you will have to pay in sterling terms there. So that's the amount that you'll pay. And that gives you what's called an effective tax rate. So your effective rate starts at 20. At the other end, if your income is £1 million sterling a year, it won't quite get to 45% because you'll always pay some at 20 and some at 40, but it will get close to it. But if your income is 1.5 million Hong Kong a year, your effective tax rate is 35%. You'll pay over 500,000 Hong Kong a year in tax. Okay, so the remittance basis clearly has an advantage, but there are some potential traps that you should really try not to fall into. Okay, and now it doesn't just apply to you as the taxpayer, it also applies to people and entities that you're connected with, and I'll explain what I mean in just a second. Okay. Now, it's very important to say that if you've got a bank account in Hong Kong, and you are moving to the UK and you're going to use the remittance basis, you need to make sure that you give your bank very clear instructions about what to do, and Anita will cover that. Okay, and there are, again, Anita will cover some of the UK planning solutions which solve all of these potential problems here. So what is a remittance into the UK? Because remember, if it's remitted to the UK, it's taxed. So any cash that goes into the UK, so that isn't just transferring money from an offshore bank account in Hong Kong or Switzerland or Jersey or anywhere else. Any money that gets transferred into a UK bank is clearly a remittance and is going to be taxed. But also any cash that you take with you. So if you go to the ATM here in Hong Kong and take cash with you into the UK, that is also a remittance, and that's going to be taxed in the UK. But it isn't just physical cash. If you're in Hong Kong and you buy any item worth more than £1,000 sterling and you physically take that item into the UK, that is a remittance, that is taxable. So if you buy a laptop here for £2,000 and you take that laptop into the UK, that £2,000 is going to be subject to UK tax. The only exceptions are things you can wear, so clothing, footwear and jewelry, provided it's for your personal use. So if you bought an expensive watch for your own use, that won't be taxed, but if it's a watch that you intend to sell in the UK, it will be. Probably the most common trap that people fall into is using their Hong Kong credit card to pay for things in the UK and then paying the bill in Hong Kong. Because you bought things in the UK, that's equivalent to taking money into the UK to pay the UK person. Doesn't matter if you're paying the bill here in Hong Kong, that's still taxable in the UK, and it's the most common trap that people fall into. If after you become UK resident, if you take out a mortgage with a Hong Kong bank to buy a UK property, that is also a taxable remittance. If once you're a UK resident, you take a loan from your Hong Kong bank and you provide any security for the loan, the amount of security you put up is a taxable remittance to the UK that will be taxed. But it's worse. If you then service that loan in Hong Kong with your Hong Kong income, that's a second remittance. So you end up paying tax twice on it. So not a great idea to take a loan out to fund your lifestyle once you're UK resident. If you take the loan out before you're UK resident, that's okay. But once you get here, everything changes. Sorry, once you get to the UK. So welcome to the UK. But it also applies to what are called indirect remittances, and this is services provided in the UK. So it's a very common scenario for people moving to the UK to send their children to fee-paying schools. And so the schools in the UK, so if you send money from Hong Kong to the UK school to pay the school fees, that's obviously a remittance that's going to be taxable. Now, some UK schools think they're terribly clever and they have offshore bank accounts, and they say, look, don't send the money to our UK bank account. You're from Hong Kong. We've got an account in Hong Kong. Why don't you pay it from your Hong Kong bank account into our Hong Kong bank account? That way, no money enters the UK. So you do that. The problem is, although no money has gone into the UK, there is a service provided in the UK, namely the education of your children. It doesn't matter where you pay the money for that. The service has been provided. That's a taxable remittance. So the UK schools think they're being clever. They're not. Any flight that you take that either lands in the UK or takes off from the UK, if you pay for the flight with Hong Kong money or any offshore money, that's also a remittance because that plane has entered UK airspace. It's not just from Hong Kong. You can be living in the UK and take your family on holiday to Spain. If you pay for the flights to and from Spain with your Hong Kong income, that's also a taxable remittance. It isn't just a remittance that's for your benefit. If it's a remittance for what's called a relevant person. So if you're remitting money to the UK for your partner, for your child, even for your grandchild, they're what's called a relevant person. They're connected to you, and it's as if the money's come into your bank account rather than theirs. That is taxable. It also applies to any company that you use. If the money goes into the company, that's also a remittance, and to any trusts as well. So those what are called connected entities. So there is really no way around this. People have tried to find ways around it. Trust me, there isn't one. Okay, now there are different types of remittance to the UK. The first is what we call clean capital. That is not taxed. And I'll show you an example of how crucial this is in just a second here. Any income that you remit to the UK is taxed because all income is taxed in the UK. If it enters the UK tax system, they're going to tax it. And also all capital gains are also taxed in the UK. Now, if you've got your Hong Kong bank account, it's probably what we call a mixture or a mixed fund, because if you just use one bank account for your day-to-day banking, there'll be a whole mixture of different things in there. There'll be maybe your salary, maybe some rental income, maybe some interest, maybe some dividends, maybe you've sold some shares and the money's gone into that bank account. So it'll all be sitting there in cash, but it'll be a mixture of what was originally clean capital and some income and some capital gains. Okay. So before you become UK tax resident, it doesn't matter because you're not UK tax resident. So it doesn't matter whether it's capital, income or gains. But as soon as you're UK resident, which remember can be before you go there, this is no longer the case. Everything changes. This is why it's crucial to know about UK resident, because you could end up with a very nasty, unexpected tax bill. Okay, so clean capital from the start of your UK tax residency can only be cash and only a particular type of cash. I'll explain what I mean. All your other investments or anything else that you own is potentially taxable if it's not in the form of cash. So if you've got a bank account, it's got a mixture of capital, income, capital gains that have arisen after you become UK resident. We call this a mixed fund. Again, this is one of our technical terms here. So, and if you've got a mixed fund, which you probably will have, and you send money from it, you can't tell which bit of the accounts it is. Was it what was income? Is it capital gains? What was it? It's one account that's got this mixture in it. So for that purpose, then, we have something called the ordering rules. This, again, is a technical UK tax term. So I'm showing an example in a second, but these are disadvantageous because any income is treated as being going first because that's taxed at the highest rates. Then once all the income's been gone, then they start with the capital gains, and then capital, which isn't taxed, is treated as going last. Here's an example. So Eleanor's living in Hong Kong. she's got an account with HSBC with 10 million Hong Kong in it. She's non-UK resident, it's clean capital, it doesn't matter because she's non-UK resident. So she moves to the UK and her tax residency began at the start of the tax year. And of course, she's a non-dom in the UK, so she wants to use the remittance basis for that tax year. So after her tax residency commences, a couple of weeks later, the bank add the interest to her account. So 20,000 interest is added to it. So it's what we call tainting the account, because income has been added to the account after she becomes UK tax resident. So it's a mixed fund. There's the original 10 million clean capital, and income, which is taxable, has been added to it. It's what we call now a mixed fund. It's tainted, even though it's all cash. Okay, so mixed fund. So Eleanor's bank obviously don't care, don't know, what they've done. But this is a very simple thing you can do with your banks, which if you're moving to the UK, you should definitely consider doing it. So there's her clean capital, the 10 million. As it stands, she could send the whole 10 million to the UK and it won't be taxed. Great. There's the interest, which is income, taxable in the UK. By adding it to that clean capital account, it's become a mixed fund worth 10.2 million. Now, Eleanor makes a remittance from that account to the UK. She said, well, I've got 10 million clean capital. If I remit 500,000, that's okay. But, I can remit the clean capital. No, you can't, because it's a mixed fund and you can't unmix a fund. So under the ordering rules, that 500,000, they say all the income goes first. So the ordering rules make up. So there was 10 million clean capital. It's now a mixed fund. So of the 500,000 that she sends, the whole 200,000 interest is treated as going first and is taxed, followed by the other 300,000 of capital. So all the income has been taken out of the account. What's left is clean capital. So she's had to pay income tax on that 200,000 interest completely unnecessarily and needlessly. Okay. So what she should have done was to say to a bank, look, there's my clean capital account. I'm going to be UK resident. I want a separate segregated interest account. Don't add that 200,000 interest to my clean capital account. Set up a separate segregated interest account and then only remit from the clean capital account to the UK. Don't touch the segregated interest account. You can use that when you're in Hong Kong. Okay, that will then mean that the whole 10 million is still clean capital, still won't be taxed to the UK. She's saved having to pay income tax unnecessarily on the £200,000 of interest. This is why it's so important to sort out your bank accounts. Now, it's also important to know how much the remittance is. So Eleanor's moved to the UK, but she's still got friends in Hong Kong. One of them sets up a tech company. So she transfers, she buys a share in the company. It's from a Hong Kong bank account, but it's in Hong Kong. Nothing's touching the UK, absolutely fine. No UK tax. Unfortunately, the startup company doesn't do particularly well. It goes down in value. So she decides that she wants her money back. So she sells a shareholding. She only gets 20,000 back. She's lost a lot of money. So she's thinking, well, it's only £20,000. I may as well send that to the UK. I'll remit it. Now, under the remittance basis rules, what she has sent back, although it looks like 20,000, it began life as $1 million Hong Kong dollars of Hong Kong income and gains. It retains its character, whether it goes up or down in value. The amount of the remittance, even it's physically 20,000 Hong Kong dollars, the actual remittance that's taxed is the original $1 million. Absolute disaster. She's ended up paying a huge amount of tax after having lost money on it. So this is one of the biggest traps of the remittance basis. It's very important that you take good advice before you start to use it. Okay, I'm just going to scoop through some of these slides because I want to make sure that Anita's got time for her section. Okay. So people say, oh, how are HMRC going to know about my offshore income and gains? Well, we have something called the Common Reporting Standard, which is where if you move to the UK, any financial account that you have in Hong Kong, they have to report to the IRD, who will send that information to HMRC. So there is no hiding place now with the exchange of information between different countries. You simply cannot hide any Hong Kong income and gains from HMRC. So they have this software that was built for them by BA Systems called Connect. It's got 22 million lines of data in it. They get all the information from the land registry, so they know what properties you own in the UK. They also get the information from all the estate agency websites, so they can see what the rental income is. They also scrape all of the online payment systems as well, so they can see who's paying for what. So if you're buying stuff on Amazon or whatever, they can see how much is being spent. They got all the information from the border agency. They can see where you're going, company's house, and so on. They get all the information from the airlines. They can see where you're flying, who you're flying with, where you're flying to, what class you're flying. They scrape all the data from the social media websites. So if you buy yourself a nice watch, take a photo and post it. They'll link that up as well. This is all done by artificial intelligence, by the way. This is not human beings. This is done by machine learning and algorithms, and they get data from the credit card companies as well. So they'll see pretty much how much money you're spending. If your declared income isn't in line with that, it will flag up on the system, not by a human being. The artificial intelligence will flag it up. So they also get information now from Airbnb as well. Okay, so there is a double tax treatment between Hong Kong and the UK. So you won't have to pay tax twice. So if you pay tax in Hong Kong already, then you won't have to pay the same tax again in the UK. But if you've got rental income in Hong Kong and you've paid property tax on it at 15%, and you're a 40% taxpayer in the UK, you'll have to pay the extra 25% in the UK if you remit that money. But obviously there's no capital gains tax here. So if you sell your Tesla shares here at a gain and you send the money to the UK, you will have to pay UK capital gains tax. Okay, that's me done. Hopefully not too much of a shock, but Anita's going to come back now and give you some good news, I promise. So back to you.
Thank you, Jason. Thank you very much. Well, very informative. Well, I certainly enjoyed the first 30 minutes sitting at the chair over there. Well, are we still moving to the UK? That is question, isn't it? I can understand why Jason, my colleagues, and my husband, why they came to Hong Kong 20, 30 years ago. But if, like myself, you decide to move to UK, I'm going to share with you some of the practical examples showing you strategies that might be able to help you and our clients. However, I must stress again, everyone's situation is different. Right, okay, let's have a look. Really, the key is to do financial planning, proper financial planning, well before you move back to the UK. Especially, do it well before the next tax year, which is 6th of April 2023. You can apply for tax in split tax year, as Jason puts it, but there's no guarantee if you can succeed. If you don't succeed in doing so, you will be taxed right back to the 6th of April 2022. Well, that's before you move to UK, and there will be nasty tax bill that you don't even realize. Well, financial planning. The most important thing today is to understand and distinguish between clean capital, income, and gains. And really, that is the hallmark of what's going to explain to you, with the rest of the slides. It can be easily done. However, clean capital, it might be easy, but if you hear what Jason says, if your banker doesn't understand what you need to do, you can easily make it into mixed funds. I heard HSBC doesn't like the idea of helping their clients segregate accounts. And even they do, they might make a mistake of transferring, the interest into the wrong account. So the probability of making mistakes is quite high. Well, if that really does happen, according to ordinary rules, potentially you will be paying 45% of the tax on the money that you remit to the UK, which you thought is clean capital. And the problem is, I can't stress it enough, the problem is, once you mix it, you can't unmix it when you're in the UK, and it becomes a huge problem. So that's why, it's a very good idea that well before you move to UK, speak to your banker and make sure you have segregated accounts for, the gains. And again, please do proper financial planning, spend time and look at different ideas. And today, I'm going to go over some exciting examples with you. Pre-immigration financial planning. Well, if you have enough clean capital for the period of time you're in the UK, that really is not a problem. And in layman terms, what it means is, if you have enough money to support your lifestyle for the time that you spend in the UK, there's nothing to worry about. There's no taxes you have to worry about. But if you do so, all you have to do is to keep everything in cash, and you lose the opportunity cost. On the other terms, inflation will eventually erode your money, and you don't want to do that. If you look at the news these days, the US raised interest, we're talking about high inflation. So most people, what they would do, they would invest some of their money, or at the very least, and try very best to beat inflation. But if you invest some money, that's no longer clean capital, and you have to pay taxes. Well, that's why I can't stress again, please, consider properly, spend time before you go to the UK and look at every single scenarios and making sure you're doing the right thing. Right, capital gain tax. Let's look at example. That's my favorite part of presentation. We have two sisters here from Hong Kong and in Charlotte, and they both got investment portfolio. And like most of us, we love stock and shares. I'm pretty sure that every one of you has some sort of shares in your account. So in 2016, they both bought Tencent for 500,000 騰訊嘅股票50萬嘅港紙. And in 4 years' time, and it goes up to 1.67 million. Pretty good investment. Amazing, amazing result. They moved to UK in 2020, but 2 years later, they really loved the UK. They decided to stay there. They want to buy properties. Right, that's the problem. They don't have any more clean capital to use to buy their property. So they have to think about a way, to use the money. And now, Tencent shares has gone down a little bit to 1.6 million. So they decided, right, we might as well sell Tencent shares and use it. And let's look at the two sisters and how it works. So let's at Anne. So what Anne does, very straightforward, she's sold her Tencent shares and 1.6 million, which is 160 pounds. And she made 110,000 pounds capital gain. 賺咗110萬港紙. And that capital gain tax is subject to UK taxes. So she has to pay 22,000, which is 226,000 Hong Kong dollars. And you can buy a few handbags with that. And Charlotte, however, she took some proper financial advice before she went to the UK. So what she did before she moved to the UK, she sold her Tencent shares at 1.67 million, and then she bought them back on the following day. Well, as at the time she was in Hong Kong, and there's no capital gain tax here in Hong Kong. However, there's no lunch, free lunch. She still has to pay a little bit, 3,000 Hong Kong dollars stamp duty. And you remember the numbers from the previous slide, Tencent shares dropped to 1.6 million. So at the time that she sold her Tencent shares in the UK, she actually made a loss, but there's no capital gain tax. Simple. But this is called washing your gains as a very simple way, and everyone can do it. So something can help you with. Now, I'm a financial advisor, and I like to make things simple, and we like to structure ways to help a client, making sure that's robust and lasts for a very long time so they can withdraw money. And one thing that seems to last every single tax changes is insurance. And you'll wonder why. Well, UK government would like their citizens to be insured. So why is it useful using insurance? And I have to recall Jason's presentation again. If you remember, anything that you hold in your personal name, including bank accounts, stocks and shares, investments, property, but all subject to UK taxes. So we talk about income tax on dividends, capital gain tax. A lot of people don't realize if you have investment portfolio with a bank or online platform, and you make a few switches during the time you're in the UK, you are subject to capital gain taxes. So insurance, how does it work? We can transfer the ownership of your investment or assets into a wrapper or envelope. And in the private bank, they call it private placement life insurance. But the technical term, really, only 2 English words, portfolio bond. And there are lots of UK tax advantages. So let me take you to the UK government website. This is the link. Don't worry if you can't read it. We're going to send you a copy of presentations to through your personal email. after the presentation. So this is the UK tax website. You can look at insurance policy taxation menu. And here you go, personal portfolio bond introduction. And let me highlight it for you. Here you go. I'm not going to read everything to you. It's not English lesson. But basically what it says here, because of the investment of property is held in the envelope of life insurance, the policy owner, which is the client, yourself, you don't have to pay any taxes to anything happens inside the bond until the policy comes to the end. So coming to the end, what does it actually mean? It means when the last insured person passes away, or if you decided to surrender policy through. Well, if you remember what we said in the first half of the presentation, if the investments are held under your personal name, you're subject to income tax. So only 55% of the money will be reinvested. Well, if you sell them, you make a profit, you pay capital gain tax. However, inside the bond, none of this happens. So 100% of your money is reinvested. This lack of taxes in technical terms is called gross roll-up. Now you'll wonder, oh, what sort of investment can I put in it? Well, it's going to be a long conversation and we don't have time to go through that all today, but I'm very happy to meet you in person and tell you a lot more about that. But in a nutshell, why does it work? The insurance policy is based in Isle of Man. And Isle of Man is same as Hong Kong. There's no income tax. There's no capital gain tax. So there's nothing abnormal about it. It's legal. Right. And then some of you will wonder, well, I already have a bank account with private bank and I have an investment portfolio. What do I do? Well, effectively, you can put it inside insurance policy. And that's the beauty of that. You're going to enjoy the best of both worlds. You can still manage your portfolio, with the bank, the relationship you have, but you enjoy all the benefits, the back tax benefits of the insurance policy. If you're interested, I'll happy to talk to you after the presentation. Well, okay, it's great, it's fantastic. I enjoy the gross roll up. But what if I need money? What if I need to withdraw some money from the bond? Right. This is the government website that we can refer to again. So gains on foreign life insurance. Basically, very simple, very straightforward. There's a 5% allowance per year. You can withdraw up to 5% of the premium that paid into the policy, or in other words, 5% of the money that you invested from day one. And if you don't withdraw it on the first year, as accumulative is carried forward, the second you can get that 10%. Onwards and onwards. I love my numbers, so let's look at some numbers. We're easy to understand. So if you take 5% every year, you can do that over 20 years without paying taxes. If you only need 4% as your income, that's 25 years without taxes, and 3% is 33 years. So there's a lot of planning you can do going forward. However, please take notes on here. This will only work if you fund the bond from clean capital. And then you wonder, well, if I withdraw more than 5%, and there's a lot of taxes involved. Well, I'm not going to go through with you today, but there's a lot of features we can use, like mini policies, sub policies, and every situation is different, but there's lots of ways we can help you maximize your growth. Now, let's look at the examples. And this is really, really, really interesting. So we got Bella and Claire, both sisters in Hong Kong. They're planning to move to the UK. And both of them are very successful women. So have 50,000, they each have 50,000 Hong Kong dollars, 50 million Hong Kong dollars in an investment portfolio of some sort. So let's assume that the portfolio goes up by 5% on average from a combination income and capital growth. And both of them decided, well, they like the UK, they like to spend 5 years in the UK, and they need to support the lifestyle, which is 1.2 million Hong Kong dollars per year, quite expensive lifestyle, so 120,000 pounds per year. Right, let's look at how they do it. So Bella, very simple, she likes the idea of clean capital. So she put aside 120,000 pounds for 5 years, 600,000 pounds in cash as clean capital. and making sure that, got segregated accounts. And there's 2% interest, a bit unrealistic, but here we go. So the interest will go into a segregated account. The remaining £4.4 million should remain invested in the portfolio. So every year she will remit £120,000 as clean capital to the UK to live on. And after 5 years, her portfolio go up to 5.6 million. And there's a £36,000 as interest. Here you go, 5.6 million. Claire, however, she thought a personal portfolio will be helpful. So she transferred £5 million, all £5 million into the portfolio bond. And every year she take out £120,000 to live on, which is within the 5% rule. There's no taxes. And after 5 years, the portfolio has gone from 5 to 5.7 million, £100,000 more than Bella. Now let's look at scenario 2 and see how much it might look like. So after 3 years, Bella and Claire decided to buy a property. They like it there. Well, very much like us Hong Kong Chinese, we love properties, don't we? So each of them will need £500,000 to buy this lovely property in London to live in. And they had to transfer some assets from, over. Well, look at Bella. So Bella, after 3 years, she still got £240,000 as clean capital. So she can withdraw that. But then she has no money to use the next 2 years. So she still need another £260,000 anyway to make this happen. So she thought, well, I might as well remit the whole £500,000 from her investments to buy her London property. But you remember that is mixed funds. And according to the ordering rules, that's how much taxes she has to pay. £381,000。差唔多400萬港紙就去咗交稅俾英國政府啦。咁 Claire 又會點樣？ Let's look at Claire. So Claire, her 5% allowance is £250,000 per year. And she only needs £120,000. So after a few years, all accumulative, she still have £520,000 allowance without the need to pay taxes. So she's already, so much more better off. And the other beauty of that, she doesn't have to file UK tax return. Apparently, according to Jason, is a hell of a lot of work to do, isn't it?
Yep.
Right. So what if they really like the UK and they want to spend more than 5 years? That's going to get very interesting. So look at Bella. She has already used up her 5 years clean capital. So from now on, she has to remit income from her offshore investments. So in order to get the £120,000 for her living expenses, she had to withdraw £190,000 to make it happen. So just look at the numbers in red. She pays £70,000 per year as income tax. Claire, very happy. Still within her 5% allowances, £120,000 per year. She's still got another 32 years. Nothing to worry about. Well, in terms of numbers, up to 2057. Fantastic. Well done, Claire. Scenario number 4. What if they do like the weather in the UK or the beautiful rain, pretty much like today? So after 7 years, how does it work? Let's look at Bella. Now, meter basis still work for her, assuming she's still non-UK domicile, but she has to pay £30,000 as the fees. Her portfolio now is only worth 4.8 million. It's going down gradually. So far, she has paid £500,000 in taxes. Claire, nothing has changed, and her portfolio has gone up quite nicely to £5.47 million. So look at that. She's £600,000 more than Bella. I don't understand why Claire doesn't speak to her sister before she went. No income tax, no fees. And then they love the UK so much that they decided to live that long term. After 12 years, Bella's remittance basic charge has gone to £60,000. That's 60萬嘅費用淨係 for remittance basis. And her portfolio is now just over £5 million, and she's paid £1 million taxes in total so far, £1 million in taxes. And Claire, no change. Portfolio's gone up to 6.3 million. Now she's 1.3 million better off than her sister. No income tax, no fees. If you remember domicile, after 15 years, this is getting really interesting for both the sisters. They both UK domicile now. They're deemed domicile. So the only thing the Bella can do is a rising basis, which means she has to pay taxes on her worldwide income and gains. Her portfolio is 5 million. She have to remit the money over for her living expenses. Now she pay up to 1.4 million pounds of income tax. And Claire, she's also UK domicile, but the bond was set up long time ago. So nothing has changed, still enjoy her life, her 5%. And now her portfolio is 7 million pounds, which is 2 million pounds better off than Bella. 佢已經多過佢家姐咧2000萬港紙啦，就係一個 proper financial planning 俾到佢嘅 benefit 啦 ，no taxes. Well, alternative scenario is a very happy scenario. It might happen to some of you. So after 6 years, they both acquired a UK citizen, and they missed the right, and so very, very double happiness. Getting married, settling permanently in the UK. So in doing so, HMRC regard them as domicile choice in the UK. So now they're both UK domicile. So once they're not become UK domicile, Bella will have to use a rising basis for income and gains, £70,000 tax per year. And Claire, no change. Up to 2057, she still enjoy her life with her income, no taxes at all. So you can see which one is a smart sister. And you know what? If I'm Bella, I'm going to speak to her, my husband, and say, you pay my 70,000 tax and I will get married to you. Right. In summary, if you hear all the examples I share with you, UK tax is very complicated. It's very high, something that we might not be familiar here in Hong Kong. Remitting basis has a lot of advantages. It's complicated. Potentially, there's a lot of traps that might be out of your control. What if your bank can make a mistake and mix your funds and you can't unmix it? So, and every year, you might have to get an accountant to help you to look at what is the best to go forward, and that's further costs along the line. Planning using insurance is simple, it's highly tax efficient, no accidents, no surprises. You can get married in the UK without any worries, meet your Mr. Right. So my advice to you is, no matter who you are, in what sort of situation you are, if you're thinking about moving to the UK, you really have to take financial advice well before you move to the UK. Now, that's the end of our presentation. But it's not end of presentation. I welcome questions from you. I can see a few questions on the Q&A sections. So if you've got any questions, please do write up. We will do our very best to answer you today in the next 2 minutes. Otherwise, we'll get back to you by email. 如果有問題嘅話咧，歡迎你哋咧用 Q&A 問我哋喎，中文都可以㗎。Jason, shall we
sure
to look at those questions? So,
self-employed with income in Hong Kong and tax in Hong Kong, should I need to pay?
So yeah, I'm self-employed with income in Hong Kong, tax in Hong Kong. Should I need to pay UK tax?
Well, you'll get a credit for any salaries tax that you pay here, but that's only up to 15%. So if you're a 40% taxpayer in the UK, you'll have to pay the extra. So you won't pay tax twice, but you'll have to pay at the UK rate, not the Hong Kong rate, if you're a UK resident.
Thank
you.
I
continue the business? This is tax.
Right.
The second question, that will depend entirely on the amounts of money involved. All of the accountancy firms produce help sheets with flowcharts on that you fill out every year. And again, it only takes a few minutes, and that will tell you whether you're better off with the arising basis or the remittance basis, because it could change from year to year.
Okay, thank you, Jason. We're actually running out of time. Should we just take one more question? And then, but don't worry, if you've got any questions, please do send us an email or send us a call. We'll definitely get back to you. So 歡迎你哋咧繼續俾問題我哋，因為今日時間唔係好足夠啦，咁所以 Jason 咧會幫我哋咧解答多一個問題喎。But please do write up all your question in Q&A. Jason, should we just answer one more question?
Sure.
Maybe one is more critical.
Will I become a UK citizen, pay tax on a rising basis, leave the UK for 6 years and sell my Hong Kong property? Yeah, so they have the what we call the temporary non-residence rules in the UK. So you might be living in the UK and you've got some Tesla shares that have really gone up in value, and you think, well, if I sell them, I'm going to have to pay 20% capital gains tax. I know, I'll move back to Hong Kong for a year, sell them when I'm in Hong Kong, and then return to the UK. Well, if you return to the UK within 5 years of selling them, you still have to pay the tax on it. So it's to stop people leaving the UK for a short period to avoid capital gains tax. So to not pay capital gains tax, you've got to have 5 tax years out of the UK. Otherwise, it's retrospectively taxable.
Well, thank you, Jason. I'm just looking through all these questions here. We have a lot more questions, so they're very valid and they're very important questions. And we are running out of time, so let me get back to you, every one of you. Don't worry, I can see all the questions. We have a lot of questions here, and we'll come back to you by email or a phone call. But anyway, thank you so much for spending time with us tonight, and thank you, Jason,
Pleasure.
for your time.
No problem.
Please keep sending us a question. We're going to leave this on for another 5 minutes to welcome your questions, and we'll get back to every one of you one by one by email. Thank you. 多謝晒咁多位，咁歡迎你哋咧繼續喺嚟緊呢5分鐘咧可以打晒你哋嘅問題，中文、英文都可以嘅。咁嚟緊聽日過往呢幾日咧，我就會逐個問題咧，由電郵好啦，電話都好啦，去 get back 你哋嘅。唔該晒，多謝晒咁多位 ，Thank you and see you another time。